Good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to the BREW, Building Relationships Every Week. Thanks for tuning in today. For those of you joining for the first time, we like to celebrate the Brewcast by celebrating today's National Day for January 19th. Today is National Popcorn Day. We're encouraged to treat ourselves to a time-honored snack. So whether you enjoy caramel corn, candy corn, or that bright yellow version that we get at the theaters and the ball games, today's their day. Fun fact, Cracker Jack came on the scene in the US when Louis Ruckheim added peanuts and molasses to popcorn. Perfect timing for Louis because at the same time, the national anthem was born. So we often associate Cracker Jack with baseball. Today, treat yourself to some popcorn. Today on The BREW, as part of our technology series, we have E4's very own Doug Twitty, who serves as Director of Annuities. Today, Doug will give us a glimpse into pension maximization. E4 has recently launched a software that provides a clear and comprehensive view of the pros and cons of PenMax. We've all been amped to show you guys this. This recent launch is really exciting for us, and we couldn't wait to have Doug on to show us around as he is the creator of this great technology. Take a look at the chat box below. I'll be keeping a lookout for your questions and comments while Doug is live. Also, all attendees are in a drawing for a prize, and we'll be announcing the winner shortly. Thank you for tuning in. And without further ado, Doug, welcome. The mic is yours.
Thank you, Abby. And National Popcorn Day is super appropriate for me as we have popcorn in this house almost every night after the kids go to sleep. They're super jealous about that. So I'm gonna jump into Pension Max. We talk at E4 a lot about not what it is, but what it does. So I want to express what this does for you, how it can help you. When a client comes to you with their pension, it's do they want to claim life only or do they want to claim life and survivor? And there's always the if, ands, or buts, right? What if this person passes away first, or what if this person passes away, or what if they both live long term and a pension is completely taxable money? So how does that play into things down the road? And we try to answer all of those scenarios and explain things in as best detail as we can. So to run through it, this will pull your client's name in and yours as well. But we talk about their specific life and joint and survivor. This particular scenario that I did, the life only option was about $6,500 a month, and the joint and survivor option would have started at $2,100 a month, and then at the participant's death would have given about $3,800 a month. And then of course it shows the cost to the participant and the lost pension benefits monthly, annually, and over 10 years, all before taxes come into play. Skip over that. Now, this is a pretty good detail of exactly how the Pension Max works, and not just in general, but this is very specific to your client. So on this one, it shows that you would need to purchase a life insurance policy of $916-ish thousand for $583 a month to replace the $3,800 pre-taxed monthly survivor benefit. So we look at the life only option, which is the most money you can get. And then on the multiple options for joint and survivor, we grab the highest income that the survivor could have. And those are the two that we run with. And we have to replace the highest survivor income with our Pension Max strategy. So with buying that life insurance, once we know how to set it up, we get the life insurance in force, and we determine how much extra money that's going to have after taxes in order for you to buy the life insurance. And then if the participant or the pension holder passes away, assuming the life insurance is still in force, of course, the surviving spouse can use that money in any way they really see fit. The way that this typically runs is we look at the SPIA needed at any given age for the spouse to buy a lifetime income at replacing that amount. So now we're comparing the joint and survivor option to our Pension Max strategy, which really is the life only option. And it tells them how much money you're going to have while you're both living, if the pensioner dies first, or if the spouse dies first. If you have a financial emergency, of course, the life insurance, if there's any cash value, can be used for that. And with the heirs, pension doesn't pay anything out to anybody else except for the pensioner and the spouse, whereas if the timing is right, the life insurance can pay out as well. So looking under the hood of this specific client, we're looking at the spouse at 55, 65, 70, and every 5 years up till 90, which is the last age that we can really do a SPIA. And the monthly income need fluctuating a little bit over time due to taxes and Social Security. And here's the annuity premium that would be needed to provide this monthly income for the rest of their life at these specific ages. And in order to fund that properly, we would set up this specific style of life insurance, right? We're going to ladder this life insurance. And you can see here, the blue line is the annuity, the monthly income needed. And the green is the life insurance. And then as the 10-year policy falls off, the 20-year policy falls off, and the 30-year, eventually we're left with just the universal life. This software does run the life insurance in multiple different ways, and we will run it ourselves to see what the premiums are and provide you the best option for that client. And then, of course, the questions that they have in their head, as we discussed, is this will pull the client's names through. It just says male and female because that's what I had entered. But it's what if the pensioner passes away in 5 years and the spouse lives forever, right? What if the spouse passes away in 5 years and the pensioner lives to age 100? What if they both pass away in 5 years? Or what if they both live to life expectancy? We can look at all 4 of those different scenarios, and we can compare the taxation of the money. We can compare the net income. We can compare Social Security benefits if we're provided all of that data. If not, that's fine. We can just provide a snapshot of the pension. And by default, we're looking at the actual standard deduction and federal tax rates increasing at about 2% per year. And then the Trump tax cut sunsets in 4 years. So this comes into play here. And then we can punch in the state tax rate. Or if you want, you could just say, give me a 20% flat tax, and we'll look at 20% flat across the board. And then just one last glimpse at what the pension looks like before we jump into it. So then we're going to look at 4 different scenarios of net income, as we discussed, right? So this will give you a yearly graph of what the net income looks like if the male client passes away in 5 years and the female client lives to 100. And then there'll be a little blurb that pops up that explains the additional or less and why. If you're wondering why this stuff jumps, just, it doesn't explain it here, but in 4 years, the Trump tax cut changes, standard deduction goes down, so the net income goes down. Then 2 years after that, the male client passes away and the spouse is left on a single standard deduction. So of course, we're left with less money. And then the year after that, they claim Social Security, which is why the income goes back up. So this all goes into play with it. Then we show an overall final wealth value. And we say which one of these provided how much more money and why, plus the excess death benefit that wasn't really needed. Because I'm going to back up for a second. Anytime after this immediate spot where a term policy drops off, you have all this excess death benefit that really isn't needed. And they can use that to further supplement income. They can use that to buy another car, whatever they want. It's their money. So if we look at the female client passing away in 5 years and the pensioner living forever, of course, the net income is higher because they're living on that life-only income forever. So it provided an additional $5,300 per year. If we look at both of them passing away in 5 years, of course, after 4 years, some drops down because of the Trump tax cuts. And you can see here the excess death benefit because we only made it 5 years. And the entire policy is going to pay out to a beneficiary, whereas the pension wouldn't have done any of that. All right. And then in 4 years, if they live till life expectancy, and it shows here that the male's life expectancy was 83 and the female's life expectancy was 86, and how much on average it would have given extra. Now, some of these bump ups are bump ups because the term policies fall off as well. So you'll notice that fluctuation. But after we look at net income, we can look specifically at taxes, right? With the pension being fully taxable, if the pensioner passes away, the spouse is left with a tax-free death benefit that can provide them a virtually tax-free income outside of the gain. And that, to me, is where the security of this really comes into play. So when we say, what does this do? This provides the security. This provides an answer to what happens under all the different scenarios of deaths. It helps show potential protection for your surviving spouse, regardless of almost what taxes do, right? Because with the life insurance, the taxes drop to nearly zero. I'm not going to say they drop to zero because you have other income. But you can see here the total taxes paid, the joint survivor would have cost $372,000 more in taxes by the time female client hit age 100. And if we look at the female client passing away, of course, this looks bad, right? The taxation of pension max is much, much higher. However, it's $5,300 per year more because of the additional $715,000 in pension benefits. Right? I don't know about you, but I'll take $715,000 extra if I've only got to pay $234,000 in taxes. So it's still a better option, right? Who wouldn't want the life only option to go forever? If they both pass away in 5 years, and then if they both live till life expectancy. Now, if we have Social Security benefits, we can really show that in here. So I think this is a big part of where it comes into play. I love the full showdown here of the tax-free Social Security versus the taxable Social Security. So you can see that the pension max, almost all of it is tax-free. The joint survivor would have taxed 52% of your Social Security benefits compared to the pension max. It doesn't even show a number. It's so low here, which I guess I should fix that. But it taxes an additional $784,000 at your highest marginal tax bracket. And it does properly calculate taxation of Social Security. And then obviously the Social Security benefits increase at roughly 2% per year as well. Just keep going through. Obviously, we're going to look at the female client passing away in 5 years, male client living to 100. Again, pension max doesn't look as good here, but it's because of the extra $16,000 per year in taxable income from the life only pension. You'll also pay taxes on an additional $3,400 per year for Social Security. So I'll take the extra $16,000 per year if I'm paying $3,400 per year in taxation of Social Security benefits. And we just keep going through, right? There's nothing here because they both passed away before they claimed Social Security. But I made it through that a lot quicker than I intended to. Should we just jump into questions?
Yes, thanks, Doug. And although you breezed through that, I think it was key that you went through each page. So thank you for doing that. I'll start with the questions as they start to pop up in the chat room here.
Yeah.
Question. Go ahead.
Well, I was going to say, if anybody wants to chat one-on-one later about it as well, feel free. We can do an hour-long run through. I can show you how the calculations go, so you really see how it works versus just the presentation itself. But the idea is for us to be able to provide you something that is beneficial in every explanation possible, that you believe and that you understand in a way to where you can relay it to your client and hopefully give them a comfortable and confident answer on how to claim Social Security and move forward with retirement.
Well said, Doug. And I mentioned in the intro that it is comprehensive. So thank you for showing us the different screens. Question I imagine would be coming from the advisors is, if they're interested in this strategy, what would you recommend that they send to their RVP to get the process started? What key information would they need to provide?
So we need a copy of the pension printout, obviously, to show the values. We need ages or date of births of the pensioner and the spouse. And then we need to know, for running life insurance on the pensioner, we need to know whether they're a smoker, non-smoker, and any potential health questions, height, weight, medical history, family history, stuff like that.
And existing insurance.
And existing insurance.
I knew we'd have some key data points. So thank you for sharing that. And for anyone on the BREW, speak with your RVP and we can make sure that we gather the correct information to provide this presentation. Any other questions from the crowd? I've got some in the chat box, but go ahead, Brendan.
Yeah, so Doug, one of my favorite things about Pension Max is just the ability it gives for, for options, down the road if, your spouse, predeceases you, or the fact that you can, effectively get, income raises, or have, potential long-term care benefits associated with your life policy. If that's, that's a concern, sort of kills two birds with one stone. I mean, you don't want to end up using the pension protection for long-term care, but if you're in a financial situation where you can, hey, that's a win. What is your favorite aspect of doing Pension Max? Like what it provides?
I'm I love Social Security. I love understanding it, and I think I love it because there's not a lot of people that do understand it. So I can answer questions, and the idea of what taxes could be in the future, the idea that the provisional income limits have never changed since they were created, and unless they do change, everybody's going to be taxed on Social Security almost at some point because we're just going to cross the threshold. So the fact that this can help provide further peace of mind on what you're leaving your surviving spouse when they're alone, to me, that's incredibly valuable. On the flip side, if you don't pass away and you don't have to worry about leaving your surviving spouse with something, this gives you total control over all of the answers, right? The difference between the life only or the joint and survivor provides a smaller income because now that company has to ensure the possibility of the fact that they're going to pay two lives forever. We can control that risk. And then no matter what happens down the road, whether you need it or you don't, you need the cash value, you want to pass it to your children, right? You're in control of all of that.
Yeah, like I said, that flexibility, that's great. You can provide a legacy with your pension, which you couldn't before using Pension Max, potentially.
Mm-hmm.
There's a question, and I'll leave it to you, the expert, Doug, but does this use a GUL product?
Well, this allows us to run any permanent policy we want. This just tells us that we need to have X dollars of life insurance in force when the spouse is 90 years old. Now, what we choose to fund that with is up to us and you. We can fund it with a GUL to keep the cost down, which is typically what we do. But if you want to run it with something else that builds cash value, obviously we all know the value in having cash value of a life insurance policy. So we could do that as well. We've also recently updated this to where it doesn't have to fund a SPIA. We can put in a rate of return. So if you want to manage the money that comes from the life insurance policy and kick income out on a monthly annual basis, I can put whatever that interest rate is that you think you'd get moving forward. So it's pretty flexible.
Thanks, Doug. Another question from the audience is, will an email sample of this presentation be provided? I'm curious, this presentation and video will be recorded and put up on our YouTube channel. Will that particular presentation be attached? How to best provide samples of this gorgeous output?
I can always email a sample. I'd much rather email you a real life case.
Yep.
But I can definitely email you a sample. You can give me different numbers if you want, and I'll send that over too.
Excellent. We'll follow up on that question, the RVP that attaches to that question. That was all of the questions from the audience, unless there are any others. Okay, as mentioned, this will be recorded and put up on our YouTube channel. So if you want to replay, it will be provided to you. Doug, at this time, I'm going to ask you to choose a number for our drawing between 1 and 23.
Well, usually I would go with 7, but I like the number 23.
Okay, 23 it is. Who's the winner? Who's the winner? Anna Larson, congrats. Be on the lookout, Anna. You're going to be receiving an email from all of us here at E4 with a coffee card and some complimentary CE coming your way. Thanks for dialing in. And be sure to tune in next week, guys, because we are going to have our lawyer friend, Sean Good, presenting on Social Security disability insurance. This is one you won't want to miss. Thanks for dialing in and have a great day. Thanks, Doug.